Interest rates. What do you know about them? Do you know what interest rates are? How can these affect you? We'll be talking all about interest rates, what interest rates are, and how they're set. So let's get into it. Hey there, aspiring eggheads. If you're caught up with the news, you've probably heard about the Federal Reserve in Canada raising their interest rates. What does this mean to you though? Interest rates play a big part in our economy. They affect the stocks in the market and how consumers spend. The Federal Reserve of the US, or the Fed, and the Bank of Canada are central banks that stabilize the economy and are necessary in its progression. How so? They control the rates that banks follow when borrowing from one another. When a bank borrows from another, it gives them access to more cash, which they can use to loan to others at an even higher rate. This is what keeps the money flowing in the economy. Banks earn from the interest rates they put on their loans, and these loans they give to people or companies. These companies use these loans as capital, which they eventually also gain a profit from while consumers borrow money from banks to buy things and meet their needs. The rate at which the banks charge each other is based on the federal funds rate, or also in Canada is what you call policy rate. These are set by the central banks, and when these rates are increased by the central banks, this has a huge impact on businesses and private individuals because these affect their loans. As interest rates in a country rise, these increase along with mortgages, lines of credit, and company bonds. The central banks pulled back on policy rates after the 2008 financial crisis. They did this to help people and businesses get back on their feet. Since then, the rates have remained relatively low. This helped banks to loan more people and businesses money at a lower rate. This allowed companies to have much lower costs and more capital for expansion. Expansion means having to hire more people. The more people being hired, the higher the employment rate. This implies that more people have more money to spend, so more money flowing into the economy. These central banks pulled back on policy rates to the point that the policy rates have stayed close to zero ever since the financial crisis. But as previously mentioned, the central banks have been increasing the rates. This means businesses and private individuals need to pay higher interest rates as well when they loan. Higher costs for businesses, less capital to hire more people, so it also affects employment and consumer spending. So it seems that raising the rates just causes more issues and basically does more harm than any good. So why would central banks increase the rates? In an economy, it is supposed to operate at a sustainable level. So when the economy is growing too quick and fast, the central banks opt to slow down economic activity. And they're doing this now by raising the rates. You can think of the economy like it's a car engine. If the car engine is manufactured to run 100 miles an hour, its maximum speed, yes, that's its optimal speed. So if you push it even further, there's a chance the engine starts overheating. This leads to damage to the car, kind of like in the economy. When there is a high economic activity, there's higher demand for goods and services because more people are employed, so there's higher consumer spending. If the demand of goods and services increases rapidly, then companies will raise the prices of their goods and services. When this happens, it's called inflation. Inflation happens when the value of money decreases. Since prices are increasing, inflation diminishes the wealth of consumers, and this can cause serious issues if this isn't kept in check. To avoid this from happening, the central banks will raise the rates, so it will be harder for people to loan money, which in turn decreases demand. It can cause higher unemployment, but it mitigates inflation. Since the economy has been doing better since the 2008 crisis, the central banks believe that it's time to increase the policy rates. There have been several rate hikes since then, and we should expect more in the future. The Fed keeps the rates at a desired range using its toolkits. Let's first mention three banks. You have the Fed. Another big bank is JP Morgan and Home Loan. Home Loan is a federal home loans bank that usually loans money to big banks. To keep it all in check, the Fed has new toolkits to increase rates. First is the IOER, which stands for Interest on Excess Reserves. A home loan can't earn from any interest from the Fed, but it can earn by loaning money to the big bank if it accepts to earn less than 0.25% interest, and by doing so, it still earns money. This is beneficial to the big bank since it's paying less interest. The Fed funds rate is kind of like an elevator with the interest rates as a skyscraper. Borrowing costs move up and down as it follows the funds rate. Because the home loan accepts to earn less than 0.25%, the Fed funds rate may not always increase. So on to the second toolkit, called the reverse repo program. Reverse repos provide a different venue for home loans to put its money in and earn interest that's set by the Fed, which is 0.25%. It's important to note that anyone who isn't the Fed is a risk to loan to. The Fed assumes that the home loan will lend money to the big bank, but with a higher rate that's set by the Fed. The Fed sets a rate depending on the market and its monetary management to deal with the economy. How does this affect you? This affects both investors and consumers. Mortgage loans, as an example, is a consumer loan which will also increase as rates go up, while fixed-rate loans over time will also increase. This is a big issue in Canada since they have high levels of mortgage per capita. Investments could also be affected since the stock market's performance weakens as interest rates rise. Because higher interest rates will make the costs for companies higher, there will be less profit for companies and as a result, lower the value of stock bond prices. Although, if you're an investor, it's not all bad news. New bond issues pay higher rates, which gives you more returns. The market will always be volatile, but if you play your cards right, practice effective investment strategies, then you should manage. What can we take away from today's video? The central banks set the Fed rates. These rates are what banks follow when borrowing from one another. It may seem that since it's only the banks that follow these rates, us private individuals aren't affected, but that's not the case. Interest rates that are set by the Fed affects us consumers indirectly and directly. This is because higher interest rates are set when we loan from banks. For banks to remain profitable, higher rates are set by the Fed to manage our economy, to prevent this from overheating and to keep it sustainable. Inflation is caused by the higher rates set by the Fed, which results in having more difficulty in borrowing money. But we should remember that it's in the aims of restoring the economy. That's all for today, eggheads. I hope we gave you a clear description of the interest rates and how they are set by the Fed. If you found this video useful, please subscribe, click the like button, and hit that notification bell to move further with each video towards being an egghead yourself. Catch you in the next video, aspiring eggheads.